Good afternoon, and welcome to the world of accounting. Today's topic is going to be the allowance for doubtful accounts, also known as bad debt expense. This is a critical account of the part of the accounting process, and what we're going to talk about today is why we have such an account called the allowance for doubtful accounts, when we have to use it, why we have to use it, and what is the objective and impact on the company's books. So that's what we're going to be covering in this session. So before I get into it, let's talk a little bit about that allowance. When you have an allowance for doubtful accounts, it's because you feel as though some of your customers will not be paying you. That's why they're called doubtful accounts. And you need to ensure that you can account for those people that will not be paying you. In order to do that, you've got to comply with the matching principle of accounting. And we've all talked about the matching principle before, which basically says match the revenue of a period of time with the expense for that same period of time. I'd like to present an example of how this concept works. So let's assume that I had two companies, Company A and Company B. And each company had a credit manager responsible for granting credit, collecting monies, etc. So I'm looking at the two credit managers to evaluate their performance. I look at my credit manager in Company A, and I realize that that company had $2 million of bad debts this year that we had to write off. Well, I'm not sure if that's good or bad. I need more information to evaluate that performance. So I take a look at Company B's credit manager for a moment. And when I look there, I look and see that Company B's credit manager had no write-offs, no bad debts all year. That's unbelievable. Phenomenal job. So now I've got to sit down and review Company A's manager and Company B's manager to see who gets the pat on the back, who gets the bonus for doing the great job. Well, I go back to Company A's manager and I look and I say, well, you wrote off $2 million of bad debt, but I need to know how much did you write off last year and the year before so I can see if you're trending up, staying stable, what position are you in? Also, what percentage of revenue are you writing off? Is it 1%, 2, 3, 0.5%? So I can see that information also. Now let's go back over to Company B. That credit manager had no write-offs. That's absolutely unbelievable. But wait a minute. If that manager had no write-offs, that tells me something really important. What that tells me is that company's not offering any credit. Because if you offer credit, you will definitely have write-offs. I don't care if you're dealing with only the U.S. government. They don't pay all their bills either. So you're going to have write-offs one way or another. So therefore, if that manager had no write-offs, and it's because they're granting no credit, I don't need that manager. So that manager's not going to get a big bonus, a pat on the back. Unfortunately, I'm going to let that manager go because I don't need a credit manager if I'm not granting credit. Now back on Company A. Well, I'm not sure if that manager's doing good or bad. I have to evaluate. If they're trending down in the amount of write-offs and the percentage of revenue is getting lower regarding write-offs, excellent job. If it's going in the opposite direction, then we need to have a talk on what's going on with the credit policy. So let's move on now to some specific examples regarding the allowance for doubtful accounts in a company that is granting credit. So I've got a company, and Barry comes into my place of business, and he wants to purchase something from me. And when he comes in, he finds an article that he likes, and it's pretty expensive. It's $10,000. And Barry says, I'd really like to buy this, John, but I don't have the money right now. Can you give me credit? And Barry looks pretty honest to me. So I said, all right, Barry, I'll let you have the credit. So he walks out and he says, before he goes, but remember, I'll be back in 30 days to pay you, I promise. And he looked like a real honest individual. So I said, okay, hey, no problem. Don't worry about it. Now that sale took place at the end of November. So 1 month later, 30 days, Barry comes into my store just as he said he would. He goes, hey, John, listen, you know it's the holiday season, and during the holiday season, you know, you buy presents for your family and friends, and well, I'm a little short on cash right now, so I can't pay you, but I promise I'll pay you in January. I said, okay, Barry, don't worry about it. Hey, I realize it's the holidays, and you were nice enough to come in and see me, no problem. January rolls around, end of January, like clockwork. Barry comes back into my place of business again. He says, hey, John, look, I really feel bad telling you this, but, you know, with New Year's and everything, and I like to go to Vegas, and I spent a little money, and I'm a little short. I promise February you'll get the money. I said, hey, don't worry. If you're honest enough to keep coming back to me, I trust you. March. Barry doesn't show up. He calls me up and he says, John, listen, I'm a little short, but I will get back to you. And he still seems honest enough to me, so I'm buying this for another month. Next month comes by, Barry doesn't call me, he doesn't show up. I get a postcard from Barry in Aruba saying, having a great time, wish you were here, pay you as soon as I return. And that's the last month I heard from Barry. Because in the following month, no call, no postcard, no visit. So I decided to call Barry up myself. His phone doesn't work any longer. I decided to go out and visit Barry's house. When I get there, I pull up in front of his house. There's boards on the windows, boards on the doors, and a big sign. Barry doesn't live here anymore. I get the message. He's not going to pay me. So now I've got to write it off as a bad debt. But I'm going to violate the major principle in accounting called the matching principle, which says match the revenue of an accounting period with the expense of that same period. Barry bought that from me in November. That was the revenue month. And now I'm going to write it off in June, 7 months later. That's a violation. I can't do it. But you're going to say, well, how could you have written it off in November? He only bought it in November. And you're right. I wouldn't have known that Barry wasn't going to pay me back in November. I have to wait until time goes by and I realize he's not going to pay me. So how can I possibly comply with the matching principle of accounting? By using estimates. Every month, based on my sales, I can come up with an estimate saying, history shows me 1% of my customers won't pay, or 2%, or 0.5%. And by doing that, when I have the monthly sales, I apply the percent against it. I can now record on my books an estimate for bad debt expense and comply with the matching principle of accounting. That method's called the percent of sales method because I took a percentage against my sales for the month. The other acceptable method is called the aging method. That's where I take my receivables, all the customers that owe me money, and I age them in brackets, ones that are up to 30 days old, up to 60, up to 90, 120, etc. And each bracket or aged category gets a percentage. The older it gets, the less likely it'll be that I'll collect it. So it'll have a higher percentage that I'm going to estimate will go bad against something that's older, and a lower percentage against the new receivables that are not old, so I don't think they're going to go bad. Now, I take that amount also. So I've got two choices, percent of sales method or aging method to come up with my estimate. Once I have that estimate, I will be in compliance with the matching principle of an accounting situation. And I've recorded it on my books. My books will be accurately stated, and everyone will be happy. Now, when you look at a financial statement and you see receivables on that financial statement, you'll see it presented one of two ways. It'll either say net receivables. And when it says net receivables, what that's telling you is, here's the receivable, but we've netted it for the allowance for doubtful accounts, the people that aren't going to pay us. So if we had 10 million in receivables and we think 1 million won't be paid, it will show accounts receivable net 9 million, meaning I've got 10 million on the books, but one's not going to pay me. So they only show you the net amount. The other presentation is to show gross receivables, which would be 10 million, and then right underneath it put less allowance for doubtful accounts. And then you'd have net 9 million. Still showing the public, you will only collect 9 of that $10 million. Now, the allowance for doubtful accounts is a contra account. We've talked about that before. Contra means opposite. So, accounts receivable is the primary account. The allowance for doubtful accounts is the contra. And that's why on your books you've got accounts receivable of 10 million and then the contra or opposite account that gets subtracted from it. Allowance for doubtful accounts, netting to that $9 million. So we comply with the matching principle, our books are correct, and the stockholders get the visibility that they should have regarding the true amount of receivables that we feel will be collected. And that's the concept of allowance for doubtful accounts. Thank you.